Hi, everyone. My name is Jason Less. I'm CEO of Riot Platforms, publicly traded Bitcoin mining company. Thank you very much. We got a great panel today talking about the halving in context of Bitcoin mining, so called the It's Halvening. I want to welcome the panelists to the stage here. We have Jeff Lucas from Bitfarms. Sam Tabar from Digital. Frank Holmes, Bulldog Frank from Hive. And Jaime Leverton from Hut 8. All right. So I know all of you very well. Take a seat, yeah. I obviously know all of you very well, colleagues of the industry. Why don't we start off going through, introducing yourselves to tell us a little bit about your companies.
Hi, I'm Sam. Can you hear me? Hello? Yes, can you hear me? Good. I'm Sam Tabar. I'm CEO of Digital. Digital is a miner that has a fleet across the United States, Canada, and as of announced today in Iceland. We are marching towards 2.6 exahash fairly quickly, and our fleet is currently, I think, almost nearly 100% carbon free. We're listed under NASDAQ BTBT.
Thank you, Sam. I'm Jaime Leverton. I'm the CEO of Hut 8. We are currently entirely domiciled in Canada, Canadian miner, operations in Canada. We trade on both the TSX and the NASDAQ. We've been around since 2018. Our claim to fame is we're the first public company to hold Bitcoin on balance sheet, and we continue to have one of the largest unencumbered stacks of any public company in the world. We are very happily in the middle of a merger that's pending final approvals with USBTC, which will give us a much broader diversified footprint into the US. We're one of the few miners in the space that has a diversified strategy. So we also have a high-performance computing division with 5 data centers across Canada. Thanks, guys.
Thanks, Jason. Let me buzz in for a riot of a time. Look at this crowd. It's great. I'm co-founder and launching Hive Blockchain, the first crypto mining company. We listed in Canada, NASDAQ in Germany. We mine using only green energy. We mine in Iceland. We source energy in Sweden and in New Brunswick and in Montreal.
Hi there, I'm Jeff Lucas. I'm the bean counter here in the room, I guess. I'm the CFO for Bitfarms. We are 200 megawatts, about 5 exahash. We've got 10 farms in 4 countries, Canada, Washington State, Paraguay, and Argentina. We're 95% hydro. We've been around for over 5 years, and we recently mined our 21,000th Bitcoin to hydro. 1,000th of all the Bitcoin that's ever going to be mined.
Awesome.
I love that stat.
So all public companies on stage here, a big part of what we do is investor relations, talking to investors all the time. And I'm sure a common piece of feedback you all hear, because I know I hear it, is how does your business model make sense in a system where your economics are perceived to have every 4 years? We're all invested in Bitcoin mining. That halving is a very positive component, I think we all agree, for Bitcoin from a supply side. But here we are betting on Bitcoin on a business model where our reward is getting cut in half. So I thought it would be good to start off. Maybe we'll start with you, Jeff, talking about how do you explain to someone new to Bitcoin, a new investor to the space, why your business model makes sense despite of that hurdle that we always have to deal with?
It's a good question to ask, but it's not impractical to assume that the cost of mining Bitcoin is going to go in half every 4 years. Think about Moore's Law. That stood the test of time for decades. And as many of you probably know, Moore's Law says the number of transistors on a chip is going to double every 18 months. So when you think about a very dynamic industry that we're in here, and look around at all of you, we're very dynamic, you're driven, you're intelligent, you're motivated. These are all the elements that can indeed contribute to the adjusting cost structures over time.
Sucking up to the audience is a really good strategy, Jeff. That was impressive.
I learned from you.
I've got my tricks, but I think you one-up me there. I think that's absolutely true. I think post-halving, the most important thing is that you're on the top half of that efficiency spectrum, because it's not the people in the top quadrant that get kicked off the network. It's the people that have the lower efficiencies that ultimately can't be competitive day one post-halving. Of course, the expectation and what history has shown us is the halving creates a supply shock that ultimately triggers the next bull run, and that's something that we all kind of look forward to and are hopeful repeats again this cycle, although you never know for sure. But I think we all have different strategies and how we are thinking about our businesses and how we're managing our businesses, and you have to think about your balance sheet. You have to think about other strategies. Some of us, we do a variety of different things across the panel here, but one of the reasons that we are looking at a continuation of a diversified strategy is just to be able to kind of pivot and flex in and out as these conditions change and evolve over time.
I think everybody in this room, including the people on this stage, is a little bit crazy just being in this sector, in this industry.
Good crazy, though, he means.
Good crazy, most of us anyway. I think you have to have a fundamental belief that Bitcoin, although it has cyclical ups and downs, that structurally it will go one way. And there are lots of reasons for that. Many of them you already know. I mean, we see something like financial censorship that goes on in Canada. That'll be a trend that people will see Bitcoin as a sort of a salvation to neutralize those types of things. And you see the gold industry, it's $13 trillion. Bitcoin is digital gold, it's only 500 billion. There's plenty to go. So yes, the halving does it does cut the economics in half. And as Jamie said, every public company has its own way of mitigating that and making sure it has a very strong balance sheet and so on to make sure that you're not just betting on Bitcoin going up in the short, medium, and long term. But at the end of the day, we all have to have a belief on the structural upside.
So I'll try to answer also. So one of the things I like to tell people, there's two parts, I think, the question. One is the fact that it's going to have, and that's going to be really bad. However, when you're limiting supply. So we see this beautiful diamond. Look at this, the gorgeous diamond she's wearing. See this? So De Beers got control of the diamond market in the 30s, and in the 40s he went with a marketing program, and only 5% of women expected to get engaged with a diamond ring. They limited supply, and they did marketing, and it's now 80%. And that diamond was originally $10 a carat, went to from $10 to $10,000. So whenever you limit supply and you have adoption, then not Murphy's Law, but Metcalfe's Law comes in that says things will grow exponentially. They will be volatile. So that is from a big picture, macro story. How do we navigate within that running the business? Clearly what everyone else has said, you've got to be really conscientious of your balance sheet. You have to be, and what's different than when the last big halving, most people had S9s. Mm-hmm. And today, there's a whole host of different machines. Now they're much more efficient from when it used to be basically 80% more efficient. However, there's a spectrum of them. So we look at it, and Aiden Killick, our CEO, is here. He runs it like as a portfolio manager does, and that's what I do also. I'm a chief investment officer, US Global. And you create a portfolio, so you have bonds maturing, and you're looking at the volatility, and you're looking at each of those unique assets, and those machines that are mining are each unique. And then you have to be conscientious of your cost of your energy. And you could take a look. Now, one of the things that always frustrates me is the Bitmains now out there marketing their machines. But if you go buy based on only revenue, that new machine, you're going to wait 550 days to get your money back on but they're trying to say, no, it's only 220 days on revenue, but we all have energy costs. So after you put in that energy cost, and if it's a nickel or 6 cents, you create that spectrum of like looking at a portfolio, then you could turn around and manage that risk better by managing the energy and those machines. And what we did in October, in November, when FTX blew everything up, machines were all of a sudden, we could buy for $10, $8 a terahash. So we could upgrade that whole fleet in that preparation. So I think anyone here that's doing their own individual mining, be careful you don't buy on that sheet that you're going to get all your money back in 220 days buying S19 Pros today. Because I'm going to tell you, after your energy cost is 550 days, and that halving is going to be painful. So that's how we function looking at markets.
So I think a common theme in a lot of the answers was talking about hardware here. And to me, that's always, well, as a miner, an interesting component of the halving. When I look back to previous halvings, in 2016, right around the halving, the S9 came out. It's hard to remember, but back then, that was the latest and greatest amazing machine. In 2020, the S19 came out just before or after the halving, depending on your schedule. And now we're coming into 2024. So I think it would be interesting to hear from you all. What is your outlook on what the Bitcoin mining hardware market looks like in the coming years, particularly around the halving? Thinking about efficiency being important. What do you guys see on the forecast of what the Bitcoin mining hardware looks like, and how are you planning your companies, your growth schedules around that? We'll just open it up to whoever would like to run with that.
I'll start. One comment here. You know, you're going to continue to see advances in the efficiency of the miners here, but it's very important not to lose sight of what really drives the profitability here. It's not only, one, for ROI, it's the cost of the miner. Secondly, the efficiency of the miner. And third, and most important by far, is your cost of energy. So we're going to continue to see these advances, and you'll be paying a premium, certainly for the XPs, for example, versus you paying for the Pro Plus. In XP, what, $28 maybe currently a terahash now? A Pro Plus at 120 versus 140 is less than half that. And so I think it's very, very important to focus on what's critical here in terms of how you effectively invest your capital to maximize that return, and importantly, to shorten your payback. Because one thing we all know coming ahead of us with the halving is uncertainty. Investors rarely pay a premium for uncertainty in the marketplace. So you really want to have a clear eye in terms of a shorter payback period and attractive ROI, and that may often warrant focusing far more on your cost of electricity than it is getting the cutting edge miner that's in place.
The payback period is really key for us. I mean, if you can get your money back before the halving, the rest of it is just a free option. I mean, we paid $9 terahash for a large batch of miners just last week, and so that's the kind of pricing you have to look at. Whereas last year it was 10x that. People were buying, they were in full throttle in their growth mode when machines were at peak price, and that's not a good strategy. Bit Digital has been very counter-cyclical when it comes to growth.
Yeah, that's smart. Maybe that's a good segue into talking about all public miners, all public Bitcoin miners focused on Bitcoin mining. There are not a lot of investors in the marketplace might look at the businesses all very similar, but in fact there are differentiated ways that that you guys all operate. And Sam, in particular, Bit Digital is focused on selling Bitcoin for staking, etc. So maybe let's talk a little bit about how each of your companies are differentiated from the pack in your strategy with Bitcoin mining.
Me first?
Yeah, please.
Sure. I mean, we don't look at our treasuries as an extracurricular activity. We don't just hodl Bitcoin. I know it's somewhat blasphemous to say this, but we do have some Ethereum, a fair amount. In fact, half of our digital assets is in Ethereum. And we stake that Ethereum and capture the rewards from that Ethereum and then pour that back into Bitcoin mining, creating a perpetual flywheel. That's really important for us. We figured out this recipe of 1 + 1 = 3. It's worked out very well for us. It's uncorrelated when getting that kind of yield. We also look at uncorrelated revenue streams. We invest in market neutral funds, and we've partnered up with a market maker at a distressed value. So we really, really pay attention to our treasuries. We don't just hodl. You have to really work the balance sheet. I think one of the biggest mistakes that some miners do is just hodl, and that's not a really good, efficient use of the balance.
Sam's fighting me now.
Your turn.
Well, look, we have, as I say, one of the largest stacks of Bitcoin on our balance sheet and very, very little leverage. So having a very robust balance sheet is what gives you incredible optionality during market downturns such as this one obviously paved the way for us to do what will be on closing the most significant M&A activity ever in the space from a public company perspective in crypto. Last year, I think many of you know, we did also put the stack to work through some yield programs, which we ultimately pulled back when conditions turned, and we have got uncomfortable with counterparty risk. I think we have other considerations. We only keep Bitcoin on our balance sheet, and I think there's good regulatory clarity supporting Bitcoin as a commodity, and it certainly reduces the complexity and exposure when we just stick with Bitcoin and fiat. But we're always using that stack to allow the business to grow and make sure we never face an existential threat like the miners we saw this year that took leverage on instead, and many of them just could not survive.
One of the things we have not done, and we have not pledged any of our assets, we don't borrow, because whenever you inherently have, I've seen this in my experience in the gold mining business, something gets so volatile, and what the covenants are, and one of the things is there's a counterparty risk. I remember being ridiculed 18 months ago for not putting money at Celsius because I got this high yield on my Ethereum. But when you start reading those agreements, and I do this in the mutual fund world, it's a very different tri-party agreement, and the covenants of protection are significantly better. So we didn't do that. We didn't borrow for our equipment. We didn't borrow for anything because experience, and I'm the oldest guy in the room, I think, is it how you deal with this volatility. So those companies that really got blown out of the box, it's usually because they didn't read those clauses. They leverage against the machines, or they pledge their coins to try to get this higher yield. So I tip my hat to you that you feel safe to be able to do your treasury function in getting capital, the returns.
Or no, we don't do the counterparty risk that you're referring to.
We're just going to be very cautious, and I'm a big believer. There's two reasons why people buy our companies: grow your exahash and hodl. And you can see Jamie's company has a huge hodl position, and that kept her valuations so strong. As your business, actually the production starts to slow down, and you're going through a merger, it didn't matter. She's like rock solid, like that diamond.
My biggest fan right here.
So, you know what I think it's
Really?
important is that when I go and talk to people, that's the first question. So how much you're hodling? We forgot to put our hodl out for 1 month of reporting, and it was like so much hate mail. You must have done this, the conspiracy stuff, etc. So that means to me that the investment public look at us like an ETF. And I found from the gold fund business, everyone wanted the GLD to come out. So all this money goes into bullion, and what did it do? It actually hurt the gold mining stock valuations. And I think if there was a ETF out today, that could actually hurt our valuations. And
A Bitcoin ETF, you think would hurt Bitcoin mining valuations?
I think so. And so just because of my experience in the gold realm, I put it back here. So we are both the miners, we have revenue, we have cash flow, and we have this unique asset, digital asset on our balance sheet.
I never disagree with Frank, but in this case, in Canada, we have spot ETFs. And even though the spot ETFs launched right around the last bull market, all of our liquidity has gone up by 4 or 5 times, despite the fact that those spot ETFs exist. So it might not be the existential risk that you reference when it launches in the U.S. It could just broadly lift all boats.
But the valuations have actually gone down a bit on what you're paying per multiple revenue and what the market is paying for cash flow. So one of the things we do is we back out all the depreciation of everybody and just look at what that revenue is and what that cash flow is to get a better idea, because the accounting board in Canada is just brutal in trying to make the industry look so bad and write everything off. I mean, we had to take non-cash charges against a real estate because Bitcoin went down that quarter. So when you look at that and you say, what were they paying in 2020 on that multiple to revenue and that multiple to cash flow? It was higher.
The thing is, if everybody's doing the same strategy, look, first of all, we are hodling. We have 600 Bitcoin. So half our digital assets is in Bitcoin. But if everyone's doing the same thing, and there are 20 Bitcoin public miners, it gets a little crowded. We have to do some things that are different, some things that are not correlated with each other, and others for the public markets to just pick you instead of just another correlated Bitcoin miner. So that's the only disagreement I have with you.
We used to be able to do that when we mined Ethereum. And I miss it because there were 94% gross margins.
I miss it too, Frank. Those were good years.
They were just beautiful margins. But I think the other part is that we're all blessed with is we have different strategies. But you can see that we all trade together. As one of my visuals yesterday, I showed like the correlation is so high that Citadel Capital is basically as a basket of all of us.
Right.
And we all trade by the minute. This morning we were all up, Bitcoin's up, okay, by 11 o'clock Bitcoin's tracking down, and all of a sudden we're down 3 pennies. And I think that people will, over time will differentiate based on geopolitical risk. Where are you mining? Are you green or not? All these parts will be like the differentiators. Are you mining in Texas or are you mining in Georgia? Like there could be differences.
Jeff, yeah.
You know, interestingly, the maturation that we're seeing in our industry now is not unique to us. This cycle's been repeated again and again and again. And what you're reaching now is when you have this, everyone involved, all moving in lockstep here. Look at what dictates the performance of our shares more than anything else, the price of Bitcoin. How much control do we have over that? Absolutely none. But what is happening, and Frank's exactly right, you're beginning to see differentiation among the key players in our industry. And how do we make ourselves different? One example I'll give it with us, we actually don't really focus so much on hodling. We're generating excess cash now above our debt service, so we are beginning to build up again. But we really have a mantra involving 3 steps here within the company. One of which really is efficient operations. How do we get every bang out of the buck in terms of using our miners more effectively? Secondly is accretive, intelligent growth, in contrast to growth for growth's sake. And that's not unusual as an industry is progressing here. And the third one, of course, like all of us here, is a strong balance sheet. But one of the reasons, though, we don't take hodling in the same vein, I think, as you do, Jamie, is because we recognize that to fund our growth in our industry, to raise equity using our at-the-markets or ATMs, as we're all doing, is prohibitively expensive. The cost of equity in our industry is anywhere from 25 to 35%. We've made the conscious decision to use our surplus cash flow rather than just accumulating over time Bitcoin, but actually to fund our CapEx. So doing with the goal of being more accretive to our shareholders.
And we're doing exactly the same thing now, selling production to fund operations. We've diversified the business into fiat-based revenue streams that bring us fiat-based income to pay our fiat expenses. So ultimately, we can do more with our assets internally.
Exactly.
Bitcoin mining, thinking about growth, some of your responses talked about growth. Bitcoin mining is always a game of growth, right? We're never sitting and forgetting for years. It's always a game of how are we going to expand or intelligently expand to continue to grow our businesses. So kind of thinking about the hardware discussion that we just had, how are your companies thinking about building new infrastructure or getting new infrastructure relative to around the halving in the coming years here? What is going into your decision-making process there? Anyone who wants to jump in first.
I think one of the things that I started doing when I joined the company 2.5 years ago, I started my career in the traditional tech space, and the first few years I was actually working at IBM at the time that IBM still had a PC division, and what we were really focused on was the evergreen program, where when we were selling laptops, we were selling programs where the client would refresh 1/3 of their fleet every year. And so when I came in, that's really how I started to look at the business. We needed to be diversified in how we were deploying that capital, different types of models, efficiencies, so we weren't stuck chasing these large capital balloons, and that if you get stuck needing to refresh on the wrong side of the halving, that can be devastating to the business. So we really, as Frank alluded to earlier, about looking at your hardware as almost as a portfolio, we take the same approach, really looking at it from a fleet management perspective, and we're always looking at what's the best next deployment of capital to keep the fleet refreshed, but you're never chasing that big CapEx balloon.
Yeah, we're very infrastructure light.
The point of compliment I've noticed is that we all have great capital market depth. And when Hive first went public, we were the only ones there, and there was all these sort of cowboys coming out, going public, and lots of BS. And today, I share with all of you today, the quality of the CEOs is phenomenal, just phenomenal. They all have capital market experience. They've all lived through down cycles and up cycles, how to communicate a story and narrative. So I think, look at Riot. You got Hubert Marlowe.
One of the greatest.
One of the greatest. And for the team, and Bitfarms has, seems Nick Goodman groomed a lot of people that now in this business. But they all have strong capital market experience, and it helps so well to deal with risks and uncertainties and novel. And some of these boards I've seen blow up, weak boards. And what happens on those weak boards? They don't have capital market experience. They don't know what it's to deal with these unexpected, novel external forces. But when you have that depth and you have that breadth, all these people here are superstars.
Yeah, thank you. On behalf of everybody. One thing we really are careful about these days is, you hear of Senator Warren. I think all of us received a letter from Senator Warren. She's talking about building an anti-crypto army, and President Biden is talking about a 30% tax on the industry, which is effectively to kill the industry. And we've Bit Digital. We used to have our entire fleet in China, and that was a jurisdictional risk. And we had that fleet before they announced the ban. And we thought, it's not very comfortable. You can get the rug pulled from under you. So we started the process of migrating that entire fleet, tens of thousands of machines, into the United States, just to hedge the jurisdictional risk.
Before the ban.
Before the ban.
Yeah.
6 months before the ban.
If you had not have done that beforehand, it would be.
And this was during the whole COVID thing, where all the supply chain was all messed up. And then we were in the middle of our migration when they announced the ban, and then we accelerated the whole thing. But we see these statements in the U.S. and we take that very seriously, which is why we've started looking at other jurisdictions. And today you'll see in the front page of the Wall Street Journal, we've migrated our portion of our fleet to Iceland. Why? Well, first of all, the energy there is very clean, got a great deal as well. But at the same time, we have to look at that jurisdictional risk. We've seen this movie before, and I think. That's one of the reasons why we're infrastructure light. If you buy too much, I know you guys have an opposite strategy, but we feel that if we're not infrastructure light, we couldn't have done what we've done in China to migrate the entire fleet. So being nimble and doing that is really key for us. And looking at different jurisdictions, being in Canada, Iceland, and the United States, we're able to diversify our jurisdictional risk and political risk that way.
Sam's a good Canadian, by the way.
So are you.
I'm in Jason's camp on infrastructure. I think for us, it's really, really important that we control as much of our environment as possible. It's one of the reasons that we stood up a repair center last year so that we could do all our own repairs and maintenance on site, and then ultimately started doing it for other miners as well to generate some extra fiat, because Jeff knows I need some fiat. So I think, we all have different strategies, but for the investor, you really need to look under the hood. There's a big difference between asset light and controlled infrastructure, and they both have positives and negatives. But I think there is a ton of differentiation, really, truly, between all of us, and all for different but good reason.
So some of the things besides we're going out and hedging energy costs and balancing the grid and getting paid for almost 4 years now, balancing the grid in Sweden. And that becomes a source of revenue, especially in December of this past year. Just tool down with software. We can tool down in seconds and then go up 30 megawatts to 3, then go back up and get paid for that is another source. But the other really excites me, what we're doing in Quebec and Lachute, 40,000 square foot data center is taking that heat and going across about 5 yards, it seems, and is heating a 200,000 square foot manufacturing building with 175 workers making whirlpools. And the big plan, hopefully this time next year, will be in Sweden, 100 miles south of the Arctic Circle. We'll have a 95,000 square foot greenhouse. So we're going to once again take that green molecule and recycle those electrons to heat this greenhouse, and they will share on the cost for energy. And so they want to raise the energy tax in Sweden, and how much will this offset? So you have to be innovate, you have to be competitive, but for us, it gives us another position with our energy bill.
So getting back to your original question here, for us, when we look at infrastructure, it really boils down to the overarching issue being low energy costs. But the second point speaks to what Jamie said, and Frank alluded to this as well, and that is the control you have over your operations. The markets and our use of power is getting increasingly sophisticated. You need to have your arms around that, because whether you have curtailment and activities like that, how do you capitalize upon that? How do you still maintain a good return on your investments while you're having a lot of this variability, much of which really is beyond your control here? And it's critical that we keep an eye on that as we're going forward.
Yeah, we make sure we get into bed with people who we're allowed to curtail
Very flirty.
on purpose.
And Jamie, we're both doing what you made a really intelligent
part, anyway.
acquisition in the HPC space. And we're doing that with our strategic partners, Raj, and I see the CEOs here, Feja. And it's taken those NVIDIA chips, which were mining Ethereum, and all of a sudden repositioning, especially with Chat GPT, is people want to, they need to have access to these chips. And so it's growing. It's not as fast as I would love, but it's free cash flow. And I think that it's going to be significantly important for Hive, and I think for yourself also, the value of the data centers. Because these data centers trade at 20 times EBITDA. I mean, can you imagine if we were all just trading at 20 times EBITDA and was stable?
Please take me there.
I'd be really happy with that.
And so I think the value which we're all creating indifferently is creating independent, decentralized data centers. The big data center being built in San Antonio by Microsoft, it's 1 million square feet. But they say gaming? No, it's NSA. So who's going to be able to get those data centers if there's such growth for GPT and now we see other innovations taking place. So I think what's going to be special is we're all these non-diversified or diversified, decentralized data centers are going to become very valuable.
It's funny you say that, because when I did the transaction to buy those data centers last year, the market really struggled with it. I got hate because it wasn't Bitcoin mining. I was investing in a diversified strategy. As many of you know, my background's in traditional tech and data centers, and I really see a world which is what led to my thesis and ultimate transaction last year, where all we do is compute, whether it's GPU compute or ASIC compute. We're an infrastructure provider that supports the next generation of technological innovation, and these worlds are going to increasingly start to converge. So we absolutely love the diversified side of the business. It's a great fiat-based cash flow, and we see just steady increase in demand, a lot of it driven by AI and ML, and I think we're only at the very beginning of that demand curve.
Yeah. Jamie, to your credit, you were sort of prescient in your timing there, because at the point in time when you did those actions here, the focus was in many respects on growth. Given what we've all been through over the past year, the focus is on stability and a strong balance sheet and those activities going forward. What makes data centers so attractive to investors? Why do they command that multiple? You have the consistency of performance, you have the visibility, you have the stability. Those are all the elements that we need to work to as well to help the margins and the multiples in our business.
Yeah, absolutely, Jeff. With our time remaining here, maybe we kind of round out and talk about bold predictions any of you might have relative to the halving, whether it's around price, around competition, hardware, capital markets. The halving is less than 12 months away at this point. What are your groups, your predictions on what the 12, 24 months from now could look like?
I think everybody here on the stage is probably building for a good liquidity position. If we are all public we have to answer to our shareholders at the end of the day. So running things at a loss is not acceptable. So, I mean, running things at a loss for a prolonged period of time, you're not prepared for that. It's not acceptable. If we stopped making money for 5 years, we're still in business. So our balance sheet is really good. But I do think that we're going to be forced eventually to figure out uncorrelated streams of revenue. That's really important. I wake up every morning thinking about, like, how can we get out of the beta and get into the alpha? I think about it every day. Because if we're just riding the beta of Bitcoin, I don't think that's going to be that's not the future. At the end of the day, you have to create shareholder value. And so uncorrelated streams of income is pretty important.
I never make price predictions, so I'm not going to do that. But what keeps me up at night is thinking about the continued pace that we're seeing the global hash rate run into having. We just continue to see new entrants coming online. We are aware of now 3, maybe 4 sovereign nations that are mining. We've got big oil and gas coming into the space. I think those types of new entrants that have really, really low cost of energy or negative cost of energy, depending how you want to think about it, really low cost of capital, driving that hash rate up. That's what keeps me up at night and thinking about how do I continue to diversify the business in the face of what I think is going to be just a considerably consistently increasing pool of competition. I think one of the things I really love about US BTC and ultimately will be part of our portfolio when the transaction closes is they've built a business called MIO, Managed Infrastructure Operations, where they're actually going into other people's sites, running the sites with their software and with their people, no CapEx deployment required. So I think these new types of business models that are fiat driven, that get you off that need for constant capital, which comes with self-mining in particular. I think it's really, really important for us at Hut 8 that we continue to drive into those diversified streams and give us the optionality to flex as market conditions change. Because one thing we know about this space is it surprises us on a very regular basis. You're never always prepared for what's to come.
Frank, May 1st, 2024 price prediction.
Look up. See that? Everyone look up? Yeah, that's Bitcoin.
Yeah.
Good one, Frank.
Yeah.
May you be right.
Go ahead. Yeah. I'm not going to add to that at all. But I think it's going to be an interesting disruption initially because there's been so much growth. And you have a bit of differentiation there. Those who are growing intelligently that we've talked about, and you had, again, growth for growth's sake. And those are the ones that are going to bear the cost of this, I think, when the halving actually occurs. What's interesting is that you have a lot of money out on the wings here. You have a lot of private equity firms. People are asking, why haven't they delved into this space yet? Especially given with the price of Bitcoin and the performance of our sector back in the November, December timeframe. Well, if you have conversations with some of these private equity guys, these distressed funds, they said, the other shoe hasn't dropped yet. But I think we're going to be realizing that when that halving comes, and everyone's sort of exposed, the tide comes down, and we see who's wearing a bathing suit and who's not, you're going to find some major shifts, I think, in terms of the concentration of the hash rate within the overall network.
What historically has happened, and we like to go back, like a good fund manager does, they do regressional studies. And I have the JETS ETF, and before I launched that as a quant product, it was 8,000 hours of regressional work. And it's done exactly what it would do, said it would do, in up cycles and down cycles. So I've lived through these down cycles, and the halving takes place. You're going to get about 3 to 6 months that's going to clean out all those poor managers that mismanage the acquisition of assets, mismanage the contracts, or they have bad landlords. Another reason why we like to buy our own sites, et cetera, because we got so frustrated with landlords. And so that will create the sort of volatility and on the Bitcoin prices. And then once they're gone, then you get a new breed of people, and you get the price start to grow. So I feel good about that cycle. You can see it each halving.
It is so difficult to make predictions around this. We've seen the previous cycles, repeat. I think we're all optimistic that something similar will happen. The supply shock, whatever other factor, results in an increase of price after. But I think the theme of what we've talked about is key focus on efficient operation, different differentiators that make your business efficient and effective to the long term. So hopefully we're here in 12 months and debriefing on how our predictions have played out. So with that, I think we're at time. Everyone, give a round of applause for our panelists here.
Thank you, Miami, for the last 3 years in this amazing city. The whole world shut down, but Miami welcomed us with open arms. We want to show Bitcoin to the whole world. We are taking the conference on the road to set the stage for Bitcoin in a new city. Nashville. Bitcoin 2024 is coming to Nashville in Tennessee, a city that is known as a music and freedom city. Bitcoin 2024 in Nashville from July 25th to 27th.